Let's talk about how options work. Most of the time we do a naked call option if we think price is going to go up. Or if there's a big move down, we'll buy some puts. But a lot of times those options will go worthless, and it's because we don't realize the implied volatility is high when we bought, and they take the implied volatility and lower it, which takes away our premium. The other thing that robs a naked call or naked put option is time decay. Every day it gets closer to that expiration date, it loses time decay. And that third Friday comes up pretty quick. You've seen where price has gone in your direction on the last week, but the option just kind of goes flat. That's because you can never gain back this time decay. So when buying options, price alone is not enough. We have to really keep in mind implied volatility and time decay. Implied volatility is a premium like interest rates. Nobody wants to pay too much in interest rates when borrowing money. That's the same thing we do with buying options. We're borrowing the right to buy the stock for a small fee. So if we flip that and we sell these options, we become the option makers collecting in that premium. Price comes down into earnings and they push that implied volatility up so that you're paying 80% when on average it's more like 50. Then after that earnings date, they deflate the value even while you have price going up in the right direction. So even if you get one of the three of these right, you still have two things that are stealing away the value of your option. And that's why we see that a lot of times a naked option doesn't work. Now for time decay is designed to always go to zero. That's a bonus premium for the option makers. Let's say you buy a naked call option and you get both implied volatility and price right. They go up in your direction. You will still have time decay depreciating against that value. In sell the news, we're looking for down trades. So if we were to do naked puts, we would want to buy low volatility, but there's no guarantee that the option makers will make the volatility go up. And we still will have to fight against this time decay. So let's focus in on implied volatility. Why don't option makers have to have this go up? They could just have implied volatility stay low. But keep in mind, if they collect the premium up here at 80, they don't make their money until they lower the implied volatility. And that's why I like selling high implied volatility, because I know the greed of the option makers is going to make the implied volatility go low so they can collect their money. They're basically charging people 80% for those options, and they dilute them down to 30%. And the difference between this is all premium for them in their pockets. So this is why I like bear called vertical spreads, because you've seen that sometimes it will give us a higher break-even price, meaning that price could go up before it comes down, making us profit. The next benefit we have in bear call spreads is buying high volatility, so when price goes down on that implied volatility, we collect it now. And the same goes true with time decay. Instead of paying the time decay, losing that value, we collect the time decay. And so don't you like those odds? Price can go up a little bit and you win price movement because you sell implied volatility. As it goes down, you make money. And every day you're in this trade, you're collecting rent on your options. So of course this trade option is going to be even better if price just goes sideways, staying under our break-even line, along with implied volatility going down and of course collecting that rent on time decay. And this trade is totally amazing when price just drops, implied volatility is collected, and we get the rent money on time decay. What are some of the pros of vertical spreads? We collect time decay, so that means that we can hold this for a longer amount of time, all the way till expiration if needed. We also collect the volatility premium. That's why we only buy high IV, over 50, but preferably higher. It reduced our costs of the trade. We can buy trades $50 to $250 because we're buying and selling at the same time, reducing our cost. It also reduces our risk. It increases our probability because we're not putting such a demand on the market. And it increases our break even on the trade. And we'll get into that after this. Now the cons of it. Our profits are limited to about 100%. Maxed out, can't do any better than that. In some options, getting everything right, you can get better ROI. Our commissions are doubled because we're doing two sides of the trade, buying and selling, making it 4 trades instead of 2. And because we're selling calls, we could be assigned to buy those stocks, which would make the margin of our accounts negative if they're ever exercised. Now to these two on increased probability and break even. So let's look at DLO. We said this was up into resistance and it had high implied volatility, so we sold a bear call spread here. You can see that implied volatility increased, not giving us the profit of that. But price did decrease, giving us profit, and we have time decay. If implied volatility did move back to this 0.80 level, that would help increase the value of the option. So back to our chart, we can see that price is under, maybe sideways or negative from where we bought it, and we're collecting the time decay. So out of the three, we have two things working in our favor, but right now implied volatility is not. On DLO, August, you can see our spread. So on our option chain, we click on verticals. We're on the call side. We're at the money spread, 45.50. We're going to sell. So we're going to use the bid column right here at the money, and the trade comes up. We're going to increase it to $2.50 because it's a $5 spread, and we're looking for a 1-to-1 ratio. Limit order, good till cancel. And here's the trade. $2,500 risk, $2,500 reward, and a break even of $47.50. That's great because right now price is right between these two, $47.64 and $47.81. Meaning if we enter the trade right now, you can see our break even is extremely close to where it's trading. But if we did a single option, we would have to buy the puts. In comparison, let's use at the money. And this is where the wow factor comes in. So in order to control these puts, it's $6,200 for the same amount of shares versus the $2,500 from before. Yes, we could make $43,000, but that's kind of ridiculous because that's saying that price would go to absolutely zero. And the other factor is, remember, we just did it. $47.50 was our break even. Now it's $43.80, meaning price would have to move down here. And I know it doesn't seem like a big deal, but would you rather have to have it go below the pink line or just below right here to make your profit? And don't forget, this is at all-time highs here. So what if this sells off a little bit? It's going to make it harder for you to collect all of your profit because if price goes down in the right direction, it looks like implied volatility will probably also sell off here. And the dreaded time decay. Meaning even if price goes in the right direction on this trade, you potentially could have two things going negative against you. Unlike our bear called spreads, with price going down, that's a win. With volatility going down, that's a win. And time decay losing value, that's a win. Having all three of these in one strategy line up for you, I think you'll see it as I do. Very profitable.